all very well behaved. Okay, we can make start. If you didn't hear me, the delay was because we're just waiting for the recording on the technology. Welcome to Birmingham Business School and to the 6th Alan Walters lecture. I'm Adam Tickell. I'm the university's Vice Chancellor, and it is a real pleasure to welcome you all here today to the lecture. The Alan Walters lecture was established in 2016 when this building opened. I missed the first 4 lectures in the series, principally because I wasn't here at the university, but was genuinely delighted to be here in 2023 for the last one, and I'm really pleased to be here today. The Alan Walters lectures provide the opportunity for leading economists and leading policymakers to share their insights on those important issues, economic issues that impact and affect us all. As I'm sure you know, the Alan Walters lecture is named, just like the building, in honour of the late Sir Alan Walters, who was a highly distinguished economist and former professor of econometrics and social statistics here at the University of Birmingham. Sir Alan was the economic advisor to Prime Minister Margaret Thatcher during a really important part of her tenure, and continued to be highly influential throughout his career. I'm delighted that, as ever, Lady Walters, Paddy Walters, is here to join us, as is their daughter, Louise. And it's a real pleasure that they come to join us. Thank you again for your really generous support, both for the lecture series and also your support for when the building was constructed. And of course, the building is part of the university's business school. Birmingham Business School goes from strength to strength, and it remains highly attractive to staff and to students, reaffirming our status as a globally respected institution. During the last 12 months, the business school has enjoyed more success. Last spring, it was announced that the school retained its place in the top 1% of business schools in the world. We kind of get used to superlatives, but being in that elite category is a really, really astonishing thing. And congratulations to all of you in the business school who continue to make us so successful. We're a so-called triple crown business school, solidifying our global importance. And the online MBA was ranked in the global top 10 by the Financial Times. Again, a real testament to the quality of education offered here. In light of this, it's a real pleasure to welcome Professor Silvana Tenreyro to give our 6th Alan Walters lecture. I'm really sorry, I didn't check your pronunciation of your surname. Silvana is Professor of Economics at the London School of Economics, a Fellow of the British Academy, Fellow of the Econometric Society, and Honorary Foreign Member of the American Economic Association. She served as a member of the Bank of England's Monetary Policy Committee from 2017 to 2023, and is a former president of the European Economic Association. She's currently director of the Centre for Economic Policy Research, International Macroeconomics and Finance Programme, and an executive board member of the International Economic Association. For her work on the monetary policy, on monetary policy and macroeconomics, she's a recipient of the Jairo Janssen, again, you may want to correct that in a minute, award, the Birgit Grodel Award, the Banque de France and Toulouse School of Economics Junior Prize in Monetary Economics and Finance, the Carl Menger Prize in Monetary Macroeconomics, and the 2023 CEPR Policymaker of the Year Award. She received her CBE in the 2023 birthday honours for services to the economy, and I'm sure we could go on. But she got her MA and PhD in economics from Harvard, completed her undergraduate degree at the Universidad Nacional de Tucumán in Argentina in 1997, and holds an honorary doctorate from the University of St. Gallen. Her main research interests are in macroeconomics, and particularly in monetary policy, in international economics and in macro development. So what a distinguished track record, and I'm sure that you'll all join me in welcoming her to the lectern to deliver this year's Alan Walters lecture, Reflections on the UK Economy Following a Polycrisis. Thank you.
Thank you very much for that generous introduction. And it's a pleasure and an honor to be here in this beautiful building and give this lecture in honor of Sir Alan Walters. Alan Walters was an extraordinary figure in academia and public policy, one of the most impressive economists of his generation. He left a lasting legacy in all the institutions he worked, including the University of Birmingham and the London School of Economics, where I come from. There's a lot going on at the moment in economics and in politics. But in my talk today, I will try to reflect on the big economic picture, where we are coming from, where we are now, and where we might be heading. So starting from where we are coming from, we've had two colossal once-in-a-generation shocks: the pandemic and the war in Ukraine, which led to an extraordinary increase in the prices of energy and other commodities, all in a space of less than 3 years. Adding to Brexit, which also entailed a major change to our economic relation with European countries, this is the most remarkable concentration of rare events, or tail events, as we call them. To give a sense of magnitudes, the increase in global energy prices alone was comparable, if not larger, than what we experienced in the 1970s. And this is illustrated in these two charts. The chart on the left shows global energy prices from 1970 to 2020. The chart on the right zooms in on the period from 2020 to today. Both charts have the same scale in the vertical axis, so the numbers are directly comparable. The blue line shows crude oil prices, and you can see here the large increases in the 70s and early 80s, the oil crisis that led to sharp increases in global inflation, touching 200% increases globally. In red, you can see gas prices, European gas prices. And as you know, gas became a much more important source of energy in recent decades. And the striking fact here is that the sheer increase in both oil and gas wholesale prices in the recent period was larger than the energy price increases we saw in the 1970s. The key difference, of course, is that between the 70s and today is that in the recent period, the increases unwound much more quickly than back in the 70s. And there has not been a second wave, at least not so far. Now, these are global wholesale prices here, but there are differences across countries on how wholesale prices pass through into retail prices, which is ultimately what companies and households pay. So when we look at retail prices, and I'm highlighting here the most recent period, we can see that despite this being a global shock, the retail energy price increases differed across these jurisdictions. So here I have the UK in green, the Euro area in orange, and the US in blue. So what we can see here is that the cumulative increase in UK retail energy prices since 2019 peaked at 115%. This rise was more persistent and stood far above the increases in the Euro area, which peaked at 80%, and the US, which peaked at around 35%. So put in terms of differences, the peak UK increase in retail energy prices was, and this is a component that directly enters the CPI basket for inflation, that increase was 80 percentage points higher than in the US and 35 percentage points higher than in Europe. These are huge differences. And so the question is, what explains this large variation in energy price increases, and why were they so much higher in the UK? There are at least 3 factors. First, differences in domestic energy production capacity. The US, as you may know, is self-sufficient when it comes to the production of gas, and indeed is a net exporter of liquefied natural gas. In contrast, the UK and the Euro area as a whole are net importers of natural gas. In fact, as I will discuss later, the Russian invasion of Ukraine and the large increase in energy and commodity prices represented a big increase in demand and a boost to the terms of trade in the US, whereas it was a very a negative hit to supply in the UK and Europe. A second difference is the fiscal response to the shock. Some Euro area countries were quicker to implement and implemented more generous subsidies to energy. And so that mitigated a little bit the pass-through from wholesale to retail energy prices. And third, scope for trade or technological diversification. Again, some European countries were quicker to expand their energy imports from the Northern Africa, for example, and or resort to other sources of energy like wind, hydropower, nuclear, and so on. So let me zoom in on the first point, which is sometimes ignored in the transatlantic comparison. For the Euro area and the UK, the energy and the commodity price increase, as I said, was a negative hit to their terms of trade. This is because, as I said, the UK and the Euro area as a whole are net importers of these commodities. For the US instead, the increase in energy prices represented a positive improvement in their terms of trade. And this is because the US is a net exporter of these commodities. And indeed, the US is also a net exporter of military and defense equipment, so the war in Ukraine also led to an improvement on this part of its terms of trade. Remember, the terms of trade are defined as the price of exports relative to imports. And these are illustrated here. In blue, you can see the big improvement in terms of trade for the US and the deterioration for the Euro area and the UK. Now, this is, of course, not just a story of energy prices. The pandemic led to a big rotation in demand from services towards goods, at least initially, which, along with supply constraints, particularly in Asia, led to large increases in global goods inflation. So this chart here illustrates this global supply pressures with an index put together by the New York Fed. And we can see how this increased meteorically with the COVID pandemic and have now gone back to normal levels. So this arguably was common to all jurisdictions. What made the difference, as I said, was the energy shock, the war in Ukraine, and another point of difference across the US and Europe was the fiscal impulse. So here we can see on the left, we see the large fiscal expansion in the US in blue. And then that compares with the somewhat smaller expansion in the UK, and one that reversed much more quickly, and a milder expansion in Europe. And this translated into households' income. So if we look at the line for the US in blue, real households' incomes actually increased relative to trend throughout this period, whereas in the UK and Europe, households' incomes decreased in real terms relative to the pre-COVID trend. So one could argue that for the US, there was never a recession in income space during this period. The inflation dynamics, which is illustrated in these charts, capture to some extent these differences across jurisdictions. We can see, again, always in green, the UK, in blue, the US, for which I have the CPI index, and the PCE, the Personal Consumption Expenditure Index, which is the one that the Federal Reserve tracks or targets. And in orange, you can see the Euro area inflation index. So here we can see that in part, the effect of the more protracted and larger energy price shock impacting on the UK relative to the other jurisdictions. We can also see that inflation in the US started much earlier on and reached a lower level than in both Europe and in the UK. But the reversal of inflation was quite fast in the UK and Europe. In the UK, it was the first to reach 2% in May last year, and it has been hovering around target since then. We're now going to go through a bump in inflation driven by the recent movements in energy prices, but the expectation by most forecasters is that when we move to 2026 and 2027, inflation is going to fall quite fast. Now, underlying this, there are some interesting sectoral dynamics illustrated here for the three jurisdictions, the US on the left, Euro area, and the UK. And we can see that basically different components of inflation portrayed here. Energy is the one that increased earlier, faster, and reverse more quickly. These energy prices are the most flexible prices in our economies. Then that followed into goods inflation, and then finally services, which is the sector with more sticky prices or more staggered contracts that tended to increase much later, but is still going through that adjustment, and it has not reversed to normal levels, whereas the others have more or less unwound. The other thing I wanted to emphasize here is the symmetry of this rise and falls for every sector. One concern that was expressed by some policymakers was that the rise and fall in inflation would be asymmetric. The fall will take a lot longer than the increase, what they call the last mile. But we haven't seen really this pattern, at least at the sectoral level, and certainly not in Europe. What we've seen is very symmetric waves within sectors, just different magnitudes or different amplitude of those waves. And when we aggregate these waves of, this is illustrated in these very stylized charts, if we have different waves that are symmetric, when we aggregate them up, the aggregate wave looks, or the average wave looks asymmetric. But policymakers can perhaps find some reassurance that the fact that services inflation is lagging behind is not symptomatic of some structural asymmetry, is still being part of that symmetric adjustment. Now, core inflation, so this, I show you headline inflation, core inflation, excluding energy, followed similar dynamics. And this is in part because most components of core still use energy intensively. Think about services. We're here in a university using energy intensively. Think of hospitals, restaurants. They all depend on energy. So this is passed through as a cost increase through all components, and the distinction is quite blurred between core and headline. So what we see here is core is a little bit flatter because the share of sticky price sectors in core is higher than in headline inflation. But other than that, the patterns are very similar. Now, what was the challenge for central banks in Europe and in the UK? And let me focus mostly on the energy shock, because this, as I said, was extraordinary and was a big source of difference between Europe and the UK on the one hand, and the US on the other. Now, if a country cannot deal directly with an energy shock, then that poses a huge headache for a central bank. Okay? And just parenthetically, some countries deal very well with the energy shock. So if you think, for example, of Switzerland, not only they have a very speedy response in terms of subsidies to energy to mitigate the impact, but they also were very quick to move into other sources of energy. So Switzerland, for example, barely felt the increase in energy prices. But so if the government cannot tackle the shock directly, or the country as a whole cannot tackle it directly, that puts a big, that gives the central bank a big problem. By simple arithmetic, in order to offset the impact on inflation of such an enormous energy shock, if you want to keep inflation at target, you need to create deflation in the rest of the economy. And creating deflation in the rest of the economy means creating slack, increasing unemployment, and given the magnitudes involved, this would have required a very significant recession, basically preventing the recovery from the COVID pandemic. So in other words, to get inflation close to target in 2022 to 2023, the UK and other European countries would have needed another severe contraction in activity with higher unemployment. And as I will argue in a few minutes, that would not have been consistent with the Bank of England's mandate, and not consistent also with notions of optimal monetary policy. And I'll come back to this point. But importantly, there are two aspects of monetary policy that are often ignored or underappreciated. The first one is that monetary policy operates with significant lags. It takes a lot of time for a change in bank rate to get transmitted fully to the economy. So I think for the UK, given the structure of mortgages, it's reasonable to expect that a change in bank rate would take at least 12 to 18 months to reach peak impact on the economy. So just to give you an example, today the Bank of England lowered its rate for a third time, but for many households that are renewing their mortgages in this period and in coming periods, they still will see an increase in their mortgage rates because they're coming from contracts, 5-year contracts or 3-year contracts that were signed at the very beginning of this tightening cycle. So it will take a long time, and it's that pass-through of tighter conditions to the economy is still going through, and the economy is still in restrictive territory from the perspective of monetary policy. The second aspect I wanted to highlight is that monetary policy is an aggregate demand tool. Raising interest rates can lower inflation by slowing down aggregate demand, whether current or expected. When inflation is demand-driven, as I argue that was in part the case for the US, then there is what economists call a divine coincidence. By increasing interest rates, the central bank manages to return inflation to its target and bring activity or output back to its potential. But when inflation is driven by an adverse cost push shock or a negative supply shock, as is an energy shock, then the central bank faces a trade-off. By reducing demand in order to reduce inflation, it exacerbates the initial weakness caused by the external shock. Okay? And in the UK and Europe, as I argue, inflation was overwhelmingly driven by a negative supply shock that was temporary. In fact, most of that is unwinding. And this is the reason why these economies have been in stagnation for some time, unlike the US, which has been going through a big expansionary period. And we can see this reflected in patterns of consumption. Here we have the US. The US had a much milder drop in consumption relative to the Euro area or the UK, and that recovered very quickly, going back and indeed above its pre-COVID trend by early 2021. So this was a very fast recovery. Whereas we can see that for the Euro area and the United Kingdom, consumption levels today are barely back to the levels they were back in 2019, and very far from that pre-COVID trend. So there's a big gap that has opened for the UK and the Euro area. Now, given this combination of lags, delays with which monetary policy affects the economy, and the fact that we had a trade-off inducing supply shock rather than a demand shock, normally the orthodox recommendation would be to look through the direct impact of the shock and focus on the second round effects. So monetary policy cannot tackle directly or offset directly the direct impact because the lags are long, but the focus should be on those second round effects, any inertia on wages or prices or any changes in inflation expectations. And this is essentially what central banks have been doing, and this is why central banks have raised interest rates so much over this period. Incidentally, this combination of lags and supply shock is a reason why most central banks tend to operate under flexible rather than strict inflation targeting regimes. So this is very clear in the US Federal Reserve mandate, which puts weight both on inflation and full employment. In the case of the Bank of England, the remit explicitly says that in the presence of trade-off inducing shocks that are large, persistent, or both, the Monetary Policy Committee can balance the speed with which it returns inflation to targets so as to put some consideration or consider the impact on output volatility. So even, again, to reiterate, assuming that the pandemic and the energy price shock was perfectly foreseeable, perfectly anticipated, and monetary policy could have acted in advance to offset inflation, fully offsetting inflation and getting inflation at target by generating a massive recession would not have been consistent with the Bank of England's remit. In response to a very large but ultimately temporary supply shock like the pandemic or the war in Ukraine, or the increase in energy prices rather than the war, the role of monetary policy is to return inflation to the target over a reasonable period of time so as to minimize the impact on future output potential and damages to employment. Now, for many policymakers, the focus was on inflation expectations, and there's a reason for that. There's a whole literature putting a lot of weight on inflation expectations. I wrote a piece for Sintra last year, actually going through the evidence on inflation expectations and what the latest findings were from the empirical literature. And a main point we learned from that empirical work is that we should be cautious when looking at household measures of inflation expectations. Those measures tend to be backward-looking, give a lot of weight, rightly, to food and petrol, which is what a large share of expenditures goes into for many households. But those household surveys don't have much predictive or extra information about the future. On the contrary, as I said, they tend to be very backward-looking. So we don't want to do double counting here. And critically, in the data at least, interest rates don't have a direct effect on expectations. They can affect expectations to the extent that they weaken activity. So it's this demand channel through which they affect expectations. So this idea that one could just hit inflation expectations without causing any harm to the economy by raising interest rates is not borne out by the data. In fact, what's interesting is that when households are asked, how do you think an increase in interest rates will affect prices, they all, or a majority of households think that increases in interest rate will lead to higher inflation rather than a decline. So they're looking at perhaps immediate impact on mortgages or a cost channel, not looking at the macroeconomy and the general equilibrium effects that work in the macroeconomy. And now, having said all this, if we look at households' measures of expectations in the US, the Euro area, and the US, and the UK, so here you can see that short-term measures of inflation expectations, like 1 year ahead, 12 months ahead, went up, rightly so, in all these countries, but longer-term measures of expectations, like 5 years or 3 years ahead, didn't move that much. So even households were not seeing this as a permanent change, and this is very different from the 1970s. Now, if we look at something that many central banks focus on, 5 year and 5 years measures of inflation expectations. So this is what they expect inflation will be from 5 years now in the subsequent 5 years, so 10 years ahead. What we see here is that inflation expectations did increase in the UK, especially following the war, but they are now back to their pre-COVID levels. In Europe and the US, they also increased a lot, but mostly getting back to their target levels after long periods of undershooting. Now, one point that Ivan Werning at MIT has been making is that these longer-term measures of inflation expectations are not really relevant for pricing decisions by firms today, because firms tend to focus on horizons of 6 months or 1 year ahead, but not really 10 years from now. So the bottom line from this is that monetary policy in tightening its responses should focus on the shorter term measures rather than long term. And in fact, if anything, the concern should be the more backward looking aspects and their impact on wages and prices rather than thinking about forward looking measures. Now, longer term measures of expectations like this one might be signaling something else. And this is, in the UK in particular, there was a period in which there were some question marks on the framework and the fiscal sustainability, and we had the LDI crisis, the liability-driven investment crisis during Truss's administration. This was a period of unnecessary noise around the monetary policy framework when it was less needed. There was a lot of noise around the target and the independence of the central bank, and that got reflected in these measures of inflation expectations, which in part explain why monetary policy in the UK has had to react a lot more than in other countries. As we can see here, the UK had pretty much the same interest rate response as the US. So here in blue and green are the UK and the US, whereas the Euro area could bring rates to higher levels, but not as high. So basically, we follow the same policy as the US, even though the US had the classical demand-driven inflation, or a bigger component of it was demand-driven, unlike the UK, where it was in trade-off territory, where you would have expected normally less of a response of interest rates. So where are we now? We haven't seen the unwind of the energy shock and its indirect effects, and the easing of all the COVID supply restrictions. So on the price front, this reversal of this negative supply shock is effectively a positive supply shock for the economy, which increases activity and puts downward price pressures on inflation. On the activity front, so we have this essentially a positive supply force acting in the economy right now. On the other hand, monetary policy has been restrictive, and this has been pushing down on inflation and on activity. So the adding up of these two forces, positive supply and negative demand, on prices is clear. Both forces put downward pressures on inflation, but the tug of war on supply, demand, on activity, in principle, the outcome is ambiguous. And what we have seen is basically stagnation for many quarters now. But what we can be sure is that both these forces are pushing down on inflation, and this is why we've seen headline inflation falling fairly quickly in the UK, fairly quickly given the size of the shock. So as I said, it got to 2% in May 2024, and it has been hovering around that value for since then. So let me, just to fix idea, this is for the undergraduate students and master students here, show you a quick sequence of very stylized facts trying to summarize all this. So this is a picture of demand and supply. We start off with inflation at target and output at its potential. The supply shock hits, contracting activity and increasing price pressures. Monetary policy then responds, pushing down on demand and then pushes down on activity and inflation. Meanwhile, the supply shock unwinds, and then again we have an extra push down on inflation and a boost to activity. And where do we end up? Well, that's the question. Let me summarize it all with a picture of GDP. GDP not always tells us the whole story, but I think in this case it's a good way to summarize what these economies have been going through. So clearly the shock was much bigger or much more felt in the UK, with the biggest fall in GDP. So this posed a much bigger trade-off for the central bank. That compares with the milder shock in the US and the euro area somewhere in the middle. Let me just tell you where I think we're going. So the big theme now, of course, is tariffs and trade wars, and some questions there are first, how big will these tariffs be? On which countries will they fall? What will be their impact on the economy, including activity and inflation? So on the first question, how big they will be, the range of possibilities is large, and these are some of the possibilities mentioned by President Trump. Let me explain what this graph is. So this shows the average effective tariffs, import tariffs in the US from the 1920s to today. We can see the increase in the first Trump administration from roughly 1.5% on average, then pick up a little higher and went down to 3% in the latest Biden administration. So from now, we can see here I illustrated 4 scenarios. The lower one, which would get us to roughly 5%, is a scenario in which China is in which we have tariffs only on China for 20%. The second scenario, which will get us to roughly 11%, so an 8 percentage point increase in the average tariff, that's a scenario in which the whole world has a tariff of 10% from the US and 20% for China. And this is exactly the same quantitatively than what will happen with the policies that President Trump mentioned over the weekend. So this is equivalent to a 25% on Canada, 25% on Mexico, and 10% on China. For now, the first two are paused, but if they were to be reinstated, then we will be moving to this second scenario, the 11%. So you can see this is a big change if implemented from where we are coming from an average of 3%. And then the last two scenarios are also, some mentions by the president at in different occasions. This will take us, the extreme one will take us to levels last seen in the 1930s, whereas the Canada, Mexico / China, which as I said is equivalent to this, will get us to the levels we had in the 1940s. So the second question, which countries are more at risk? Well, the ones with that hold a larger trade deficit with the US, China, the EU. Within the EU, Germany is the biggest trade deficit country. Vietnam, Mexico, Japan, Canada. Those would be the big ones. Also, European countries with low shares of defense spending over GDP. And here, the big countries in the Euro area, Italy, Spain, France, and Germany, and also Denmark would be first in the list. So what will be the impact? And I'll try to I'll go fast now. So most economists would expect an adverse impact on global growth in terms of prices or inflation. The impact might be limited in the US, depending again on the size of the tariffs and how much gets passed through. And the impact on other countries is ambiguous. And let me try to explain why. So in terms of the impact on the UK, on the US, on US inflation, here I did some back of the envelopes calculation. So imports, US imports are roughly 11% of US GDP. So if we impose a 10% tariff on the whole world and 20% on China, that would lead to roughly a 1.2, 1.3% increase in, or 1.3 percentage point increase in inflation. And that would be a one-off. That would be the maximum effect, assuming there are no exceptions. We can think of many reasons why the pass-through of tariffs to inflation will not be as full. In part, there will be an appreciation of the dollar. Exporters might cut their prices somewhat. Importers might absorb some of that in their margins. There might be some trade diversion and so on. So this is a maximum effect. In countries on which tariffs are imposed, so say the tariffs are imposed on China, we should expect lower prices, certainly lower export prices and an excess supply, at least for some time, as long as there's no retaliation. If there is retaliation, those countries will also see increases in their prices. And the more so, the more open they are. And in third countries like the US, like the UK or Europe, assuming that there are no direct tariffs on those, well, we will see higher imports from China or the countries that are tariff affected, and that should put downward pressure on prices. So we can have a whole constellation depending on what those tariffs are, where they go, and whether there is retaliation or not. And we have some evidence from the first Trump experiment in his previous administration. We saw that tariffs were passed through to import prices, exporter prices did not fall much, except for commodities like steel and agricultural products. Importers paid the full tariff, but importing firms absorbed a lot of these margins, so there was very little effect on retail prices in the US from the first administration. Obviously, those, again, were much smaller increases at the time. There was evidence of trade diversion, so an increase in non-tariff affected products vis-a-vis tariff affected products, and some new countries acted as hub or diversion, like Mexico, Vietnam, and so on. So there was some evidence of that diversion of trade routes. And then there were also some interesting price effects, so firms recouping margins by increasing prices of other products. So for example, when tariffs were levied on washing machines, companies increased the prices of dryers as well, just to compensate for the lower margins on washing machines. What happened to bystander countries like the EU or the UK? We found evidence that import volumes of those tariff-affected products increased, and retail prices of those products decreased, fell. So there was a disinflationary effect at the time. How do central banks will think about these effects? Again, for third countries, there's little trade-off. So this is disinflationary and should affect activity negatively. So we shouldn't expect further increases in rates. At the opposite, if anything, we should expect rates to be lower vis-a-vis the reference scenario. For the US, if these prices are small indeed, the Fed could see through, as long as the labor market is sufficiently loose and there's no movement in inflation expectations. If higher tariffs are imposed and or second round effects are visible, then they will need to raise rates relative to the no tariff scenario, which in practice might mean that the Fed might need to delay further loosening. So there's much talk about divergence between Europe now, Europe, UK versus the US in terms of policy. But one thing that economists seem to agree is that in all, the real equilibrium rate of interest will end up falling or is falling already in these economies. And these are the latest estimates from the New York Fed. They don't have estimates for the UK. They only give it for Europe and the US. So let me pause here because I'm already over time. I thank you again for inviting me, and I'm happy to take questions on any of these points.
Sorry, I'm Kaushik Mitra, Professor of Economics. So time for questions then after this very interesting talk. So if you just raise your hand and wait for the microphone to arrive to you before you start speaking.
You can also invite people on Zoom to ask questions.
Okay, and people on Zoom can also ask questions.
Thanks very much for a very interesting talk. I was thinking when your talk was announced as being about crises, there are certain crises you didn't mention that have happened in, not too distant past, namely the global financial crisis and Brexit. I don't know whether you have any thoughts on those. But what I was primarily wanting to ask about is the sort of policy framework. I don't think you said anything very much about the policy framework, but we've seen significant changes in the way in which monetary policy and to some extent fiscal policy have been conducted over the last, I don't know, 30 years or so. We've had monetary policy independence, and with fiscal policy, we've got the Office for Budget Responsibility set up, and you know, we've had various rules for fiscal policy. You know, the debt GDP ratio should be falling in the 5th year of the forecast period and things like that. It keeps getting changes. My basic question is the economic policy framework, the monetary policy and the fiscal policy institutions we have, are they appropriate for meeting the various challenges we face, or would you recommend changes in either of these institutions? Thank you.
Yeah. So I mentioned Brexit a bit en passant when I mentioned, I mean, we've lived through 2 mega crises, mega shocks, the invasion of Ukraine with the increase in energy prices and the pandemic. This is unthinkable in such a small period. And adding to Brexit, which is obviously more specific to the UK, this is a massive cocktail of shocks. And you know, when you think about the magnitude, this is, you know, the 70s plus the pandemic plus Brexit, and inflation increased a lot and it was painful, but is more or less back to target now in a space of, again, three years. And that's the monetary policy framework, which proved robust to the most unthinkable sequence of shocks. And that, I think, is a big difference from the 70s. If we think of the 70s, which just had the oil shocks, they got stuck with very high inflation. There was no target, so no way to think about, you know, even what monetary policy should be doing. And so that's a big lesson that I would draw on the monetary policy side, that having a clear framework, having a clear target helps, you know, guiding policy, and we managed to go through these painful shocks in a, you know, minimizing the pain. I mean, given the size of these events. In terms of the fiscal framework, I think that's a complex one. I mean, I think, you know, on the cyclical, I think maybe some parameters could be adjusted. You know, I think I'm very much in favor of furlough schemes, but the calibration of the scheme perhaps could be, you know, rethought with what we've learned through this crisis. I don't think we had an energy policy to react to the shock, and that's fundamental if we think that we're entering into a new era in which there will be more supply shortages in critical inputs. Because of climate change, because of geopolitical tensions, and the country needs to prepare for that. And we don't have a prudential framework to think about those, or at least I haven't seen it. And such a prudential framework, I mean, when you think about these big shocks that might hit our economies, it needs at least 3 elements. One, a component of technological diversification. We need to be investing in critical inputs and in inputs or technologies that have low substitutability, so that we're not exposed so much to a new, you know, critical input shock. Like, could be anything from energy to water to food, etc. So the country needs to invest on technologies and inputs to be prepared. Second, more trade diversification with countries with low geopolitical risk. The idea that has stemmed from the pandemic was, to some extent, reshoring to build resilience, and that's not a good idea. You are concentrating your risks in the domestic economy, but if we have massive floodings, or that's going to be a bad idea to reshore fully. And the third one, to think about having safe inventories, building buffers for, you know, big crises. And again, maybe it's not immediate, but we should think about shortages in these critical inputs that might put the economy at risk. And so I think we need to think more about what's coming with climate change and what are the climate events that might shock our economies, and do preventive work, minimizing the exposure to that, and also have a strategy to respond to those if they were to materialize. And so this is a room full of economists, and there's a lot of work to do and thinking to do about this, and I think it's a very fertile field for work. And
Hi, I thank you, Silvana, for the nice presentation and with a lot of facts of data and graphs. So my question is quite, related probably with everybody or most people in this room. Not all of us may have the form to invest, but most of may have a mortgage. For our students, I believe some of your parents may still have the mortgage, right? You maybe can give some insight for suggestions to your parents. So my question is that you mentioned the monetary policy will have some lags. So in the ambiguous future that we don't know how soon or how often the Bank of England will reduce the interest rates, right? So as the households, so in this time of the period, should we switch to a short term of a mortgage, or should we maintain to get say five-year mortgages, right? Do we see kind of this evidence in the past that says that when the Bank of England increased the rates, that people tend to take 5 years? Well, when now they want to reduce it, it is 2 years, right? I think that the percentage of people take the longer term mortgage or lower term mortgages will have the impact on their consumption patterns. That's something I was suspecting here. Do you have any advice to us on this? Thank you.
Yeah, I'm not a financial advisor. I'm sure many people here know a lot more than me, but just intuitively, interest rates, I would expect them to go down, and the thinking on equilibrium real rates is that they will go down. Why? Because what's behind this is demographics. I mean, our societies are aging. We're all aging, but our societies are getting older. We need to save more, and this is a big source of pressure down on interest rates. So that's a trend. Obviously, there might be shocks that move us away from those, like what we've just had. But yeah, so if you want to think trend, we're going on the down, and if we don't face any shocks in the immediate future, then I would say you should expect interest rates to go down, and that probably gives you a clue that, if you're renewing right now, you shouldn't get stuck on a very high mortgage rate. That would not be, but I don't want to give advice. That's not my, I'm not my, yeah.
Yes, just a quick one. Thank you very much for your talk. Very interesting. Professor Lisa De Propris, the Chancellor and the UK government is at the moment really obsessed with growth, but they don't have any fiscal bandwidth. They don't have any instruments because they don't want to spend any public funding, and of course increasing taxes is not very popular. So do you think that dropping interest rates, what would be the impact of that? To what extent this is actually a good day for Rachel Reeves, in a sense? Will this a little bit help her in this growth ambition, or is actually very much a very small marginal improvement that will have no medium term and long term? Thank you.
So we know from the evidence that a cut in interest rates moves up activity and employment and gets the economy going. There's more fair formation, there's higher investment. We're talking right now about very small moves. So we're still in restrictive territory relative to where we think, or most economists would think the equilibrium rate is. So monetary policy is still very restrictive and obviously making it difficult for companies to get started and for investment to take off. But obviously that's part, if you think of just an instrument, that is the one that the Bank of England has, and the Bank of England has a remit for inflation, so it cannot just reduce interest rates without paying attention to inflation. So I think what you want to think about when you're thinking about growth is other levers that can move the dial in more substantial ways and in a more ambitious way, and how to think about the main pillars of economic growth. I mean, we would need human capital, innovation, digital, physical capital, and so how do we move those? Interest rates are an important part, the cost of funding, but there are many other measures that do that. And again, I think, it's a difficult situation the government is in because it is constrained by by its own rules, and so let me say interest rates will help some bit on the margin and will get us will give a boost to the economy, but the big thinking has to come from somewhere else.
One very quick one from our online viewers, lest they think we are ignoring them. How do you assess the long-term effects of energy price volatility on the UK economy, and to what extent do you expect energy price fluctuations to continue shaping inflationary pressure in the future?
Yeah, that's an excellent question. Look, if we all think that this volatility will continue and we will be subject to recurrent shocks to energy, and so this is if X, and there's no action taken to respond to that, so we continue as we are, then many possibilities arise. I mean, we're going to be subject to a lot more shocks like we had, but also with that outlook for the economy, there will be less investment that will affect also consumption. So there will be a contraction both in demand and supply in the economy. So I think this we need to think here in general equilibrium. The effect on inflation, I don't think is going to be material because eventually demand will also adjust, and real wages and real incomes will fall in the country. So we need to think, when we think about these real shocks to energy prices, there has to be a real strategy. This is not a job for monetary policy. This is an important resource in the economy. Monetary policy can bring inflation back to its target. That's all it can do, but it cannot tackle the real consequences of these shocks. And so this is where you need an energy strategy and a strategy for all critical inputs, not just energy. It's a super important question. I think the effect of inflation is almost second order because the real thing, when you have all this volatility embedded in the forecast, is going to be on demand, investment, and ultimately consumption and incomes.
Okay, so thank you. So we are out of time, and so I should thank Silvana for giving an excellent lecture. So please. So I really enjoyed the lecture and hope the audience did as well. So, I knew there were some more raised hands. So there's a drinks reception right outside in the foyer. So you can, Silvana will still be there for some more time. And for those of you who are going to dinner, please leave at 6:45 for Megaprofs.
Thank you very much.
So overall, yeah. So just to say, it was a very excellent presentation, generally. And I like the fact that you compared the US, Euro and the UK. So comparative, and there were some, I had one or two questions, but maybe I can ask them outside as well. So, but overall, and so many pictures and graphs, I'm sure if I teach like that to my students, they will
You can use them.
So good.
I'll send you the slides.
So thanks a lot. So
Thank
let's go
you.
outside.
Very good.